Good morning, this is Roger Royse, the Royse Law Firm. I want to welcome you to Crowdfunding for Equity. Today's webinar is going to discuss the Jobs Act generally, crowdfunding, raising money through the new crowdfunding rules. We've got a great panel put together for you this morning to discuss the Crowdfunding for Equity programs, especially in light of the new rules that were just proposed and enacted and finalized last month. So before we start, a few housekeeping items. I'd like to remind everybody that this is part of the Royse Law webinar series. We've had programs on health tech, fintech, AR, VR, artificial intelligence, and we've got programs coming up yet this spring on water tech next week and FIRP, foreign investment in U.S. real property. Today, the focus is not so much technology. The focus today, well, maybe a little bit of technology as it relates to crowdfunding platforms, but how to raise money through these new crowdfunding rules. We are recording this webinar, so you'll be able to watch it later. You'll find it posted on the Royse University site, webinar site. You'll find it on our Royse Law YouTube site, and it'll also be available for download as a podcast in the iTunes podcast store. So briefly, you probably all know by now that it was about 4 years ago that the Jobs Act was enacted, signed into law by President Obama, and you can go ahead and put my slides up, Jeff. And it went ahead and the idea was to provide additional access to the capital markets, relax in reporting and disclosure requirements for private placements and certain other more broad placements. It provided for exemptions from registration, additional exemptions from registration for the issuance of securities, and changed a few other rules, increased our 500 shareholder registration limit for public offerings, and allowed significantly for general solicitation in what typically were what we call 506 offerings, private placements. The reason this is important again and why it's back in the news and you're hearing a lot about it is because as of last month, May 16th, regulations were finalized allowing for what we call Title III fundraising or retail crowdfunding or crowdfinancing, which allows companies to raise a limited amount of funds from the general public. And I'll let our panel discuss that in more detail. So currently where we are is we've really got three, depending how you categorize it, really three types of platforms. One is this Title III crowdfunding in which non-accredited investors can invest through a portal or a broker in companies relatively small amounts. We've got Title II, which is for accredited investors, but it allows companies to solicit and advertise. And then we've got Reg A, which are, think of it as a mini IPO. And we have a group of panelists here that are expert in all three of these areas. They run their own platforms or they provide services with respect to advising on how to do any of these. So our panel consists, let me just give you a rundown and I'll turn it over to our panelists. Gene Massey, he's the CEO of Media Shares. He does quite a bit of consulting on these sorts of placements, including Reg A+, what we call Reg A+. Those are the mini IPOs. He also CEO of the company QuickShares, which offers crowdfinancing and crowdfunding solutions for Reg A+ offerings. Adam Hooper, he is the founder and CEO at RealCrowd. It's a Y Combinator and venture-backed business that they found a way to use crowdfunding to invest in real estate. And RealCrowd is one that you've probably heard about if you've followed the real estate crowdfunding news at all. Dara Albright is a very well-known, recognized speaker, writer, and influencer on topics relating to market structure. She has a blog post. She's a prolific writer and is very opinionated on the regulatory issues around new issuances, fintech, and crowdfinancing generally. So I'm sure Dara will have quite a few ideas on where this is going and where it should go. And then finally, Patrick Robinson is with CircleUp. It's a San Francisco Bay Area crowdfunding organization. They've got a little bit different approach on their platform. Patrick can talk about how CircleUp handles crowdfunding. So I want to remind the audience that if you have questions during the program, you'll notice that there is a dialog box that says questions on your screen. I'm expecting a lot of questions here. I doubt that we'll get through all of them, so you know, ask them soon, and we'll do our best. But go ahead and type your questions in. At the conclusion of some short introductions and presentations by our panelists, we'll go ahead and turn this over to questions. If we can't get to them today, we'll have people follow up with you later. But I'd like to make this as interactive and responsive a discussion as possible. So with that, Gene, I'm going to let you go ahead and introduce the topic and maybe give us an overview of where we are. So,
sure. First of all, Roger, I want to thank you for being part of this. You're distinguished law firm. You're real experts in this area, and I'm grateful to be included with the stellar lineup today of experts in this field. My first slide is about the history of crowdfunding, and I don't want to disappoint anybody, but it's not new. It started in 1606 when the Dutch East India Company first issued stock. They decided, well, let's get a bunch of investors to invest in something, and that was a very successful company for a couple of hundred years. And then, of course, everybody knows about the creation of the New York Stock Exchange with the Button Agreement in 1792. At that time, if you wanted to sell stock, you basically either mailed somebody a letter with an offer in it, or you walked across the street and knocked on their door and you tried to sell them some stock. So it was a primitive means of communication to shareholders of an offer. And then the ticker tape came in with the telegraph, and that was a truly transformative event, because at the time many companies were actually out of business, and that in some place in the United States, and they were still selling stock in that company on the New York Stock Exchange because the communication was so poor at the time. And this is the ticker tape was before the telephone even. You know, it was the telegraph at the time, and so they would very often companies would be out of business. And then in 1876, the telephone came in, and that allowed a person selling stock to actually call up somebody on the phone and sell them some shares and make a deal, and then probably follow up with the paperwork, but they could actually call up a whole bunch of people on the phone. And then came the internet. And so this is what has happened. It's not crowdfunding now, it's internet funding. And if you think about it, what has happened with the birth of the internet allowed an issuer of stock to contact millions of people on the internet and sell their stock online. And that, of course, you had the birth of online brokerages. And then on April 5th, 2012, the Jobs Act was signed, and that was created because everybody realized, wait a minute, we can get funding on the internet now. And that's, as many people have said, that's the best thing that's happened to the securities business in 50 years. At the time the Jobs Act was signed, we were working on many securities rules that were 50, 60 years old, and some still are, by the way. And so we're in the middle of a huge revolution in being able to reach enormous numbers of shareholders, potential shareholders on the internet, and being able to expose your offering as an issuer to millions of potential shareholders. That is scary to the regulatory agencies. They're afraid, oh my goodness, you mean somebody can post an offering on a website, and there's all sorts of possibilities for fraud there. And as it's turning out, the fraud, the tremendous fraud that everyone was anticipating is not happening. My two favorite things that of all the Jobs Act rules are Regulation D 506C and Regulation A+, which is Tier 2 of Regulation A. And Reg D allows us to generally solicit. Before this rule, you could not call up strangers and sell them your offering. You had to only contact people that you knew. And you could not contact non-accredited investors, hence Regulation A, which is a modification of the old Regulation A, which now allows you to raise up to $50 million on the internet and sell shares to non-accredited investors. And I'm sure the other folks will have many things to say about that, so I won't go too deep into it. The thing about selling shares online is it requires two things. How are you going to market your offering to investors? And once you market the offering and they go somewhere on the internet to buy some shares, how does the transaction take place? So that's really the essence of online share sales, is how do you market the offerings, and then once they get there, to either to your website or to a portal that has a number of offerings on it, how do you transact it? And so in marketing the shares, you have not eliminated the possibility of working with traditional brokers. Just because your offering is on the internet, you don't have to eliminate brokers. As a matter of fact, most of the offerings now are the issuers are working with brokers, but you are still using social media to advertise the offering in addition to the brokers who market to their investors. This is sort of a hybrid now, and the days of only selling your shares by a broker, calling up shareholders on the potential share purchasers on the phone, we make a joke and we say that's like going door to door with vacuum cleaners. It's just not there anymore. Everything can be done online now, but there are brokers that still call up people and sell them shares. If you're selling shares through social media, you're using all the typical tools. You're advertising on Facebook, you're advertising on websites, you're email marketing to your targeted lists of customers, fans, users, affinity groups, and you're partnering with others who have an interest in your potential offering and who have online communities. Now, yesterday, I moderated a panel here in Los Angeles, and one of the issuers who is currently marketing his shares online was telling me that he'd tried 3 different advertising agencies that were not successful in marketing his shares. In other words, he spent a lot of money, and it was difficult. He was not making sales. He finally got another agency, and he was spending $10,000 a month for the agency's fee and $25,000 a month for the ad placements. And so he was spending $35,000 a month, and he said he was doing so successfully. So to market your shares, you're going to have a budget. People call me up and say, I want to do an offering, and I say, what is your marketing budget? How are you going to sell your shares? And so that's something that needs to be considered, and the other panelists will talk about that when we get to them. But if we could go to the next slide and talk about the transaction is actually not as simple as one would think, because you need, first of all, you're under very difficult FINRA rules. If you're selling stock on a website, you have to abide by some pretty serious rules. The old way that it was being done was someone would say they wanted to buy some shares, and you would send them a subscription agreement. They would sign it, mail it back to you, and they would mail you in a check. That might have been done electronically, but that issuer was still, the shares were still held in a transfer agent. And now QuickShares works with a brokerage where it's all, we actually work with Folio Institutional. Via Folio is a website that can tell you more about it. We actually work with Folio, and the shares are held in a brokerage account to start with. And so a person can actually open an account and have the shares transferred from an account to their account. So they're not in a transfer agent, which then needs to move the shares later into a brokerage account. And that has been a very difficult process in the past. And so basically what we do is we make it easy for an issuer to put a page on their website and actually sell shares. This can be on an issuer's website or on a portal. Most of the portals handle the transactions in-house, and as you'll be hearing more about that later. But that's about it for me. We're a consulting firm, and Media Shares is a company that helps issuers sell their offering. We do marketing. We do help people with the transaction of the share sales by introducing them to the brokerages that will actually do the transaction on their own website or on their portal. And that's it for me. And so if we could go on to the next panelist.
Okay, thanks very much, Gene. I appreciate that. So with that, Adam, are you there, and would you like to say a few words about RealCrowd?
I am, and thank you again for the opportunity to participate today. Gene, a lot of good information there. I'll probably cover some of the same stuff and see if we can zip through these slides and keep some time open for Q&A. A little bit about myself and RealCrowd. We started the company in early 2013, so we were one of the first 2 or 3 real estate crowdfunding companies that got going. Came from a long career in real estate. My background was on the joint venture equity side, so raising primarily institutional capital. And we saw just a tremendous opportunity with this new regulatory environment and the ability to wrap it in a layer of technology to bring efficiency and scale to distribution of these securities, and then also bring access to investors to participate just at a scale that they haven't been able to do so before. So next slide is just a quick kind of overview of what we do. Online platform, and our whole goal is to provide direct access to investors to these private real estate offerings. And so we don't get in the way of forming any intermediary LLC. So as an investor coming into a deal on RealCrowd, you have a direct relationship with that sponsor. You own that underlying security directly. It's not through any holding company or anything that we form. And we just think it's much more transparent and efficient to have that real direct relationship between the investor and the sponsor. Next slide is just a little bit about some of the points that Roger and Gene already touched on. Why is this happening now? Why have we seen such a huge increase in crowdfunding platforms? Both real estate, our space, consumer products, startups, all different types of industries. And the biggest catalyst for this was this regulation. To date, all of the deals that we've been doing are in this Regulation D, Rule 506C space, which allows for the advertising of a private offering. So prior to the Jobs Act and the approval of Title II in September of 2013, you couldn't sell a security, a private offering, you couldn't sell that security to somebody that you didn't have a pre-existing business relationship with. And so September of 2013, that prohibition of advertising was lifted, and you can now, as an issuer, you can now advertise to the public that you're raising capital for a private offering. Some additional restrictions come with that in terms of accreditation. So investors have to be accredited, and you have to take some additional steps to verify that accreditation now. But the ability to change what's always been a one-on-one conversation to leverage the distribution potential of the internet, which is, in social media, as Gene was talking about, you take what's always been a phone call, and now you can have that same conversation with potentially millions of people with a couple clicks of the mouse. That's a pretty transformative shift in how you can distribute these opportunities. Regulation A+ is a newer method of raising capital. I think we've seen mid-30s, 34, 35 Regulation A+ offerings have been approved or at some stage of approval by the SEC. So a little bit more new than the Reg D. We see a pretty big opportunity in the real estate space. We're in conversations right now with probably 5 or 6 different groups that are going to be launching Reg A+ opportunities. And that allows you to raise now up to $50 million from non-accredited investors. That was a big change. Again, prior Reg A rules allowed you to raise only up to $5 million, and it was an intra-state offering. So you could only offer it to people in the certain states that you filed the registration in. And now there's a federal exemption with this Reg A Plus, so you can offer it in all 50 states to non-accredited investors. So I think we'll see a pretty big opportunity for that here in the second half of this year. And then regulation crowdfunding, Title III of the Jobs Act, just recently enacted just a few weeks ago. Not sure how much application that we really have in the real estate space. There's $1 million per year per company cap. The size of transactions that we work on, don't really know if it's going to be that impactful, but it'll be interesting to see how that plays out. And then the other side of that is the distribution. Again, as I talked about, we're seeing a lot more investors are just aware that this thing is even possible. Now, there's been a pretty big wave of press, and I'm sure Dara will talk a little bit about that, but just the kind of mainstream adoption of what it means to be able to have access to these deals and just the awareness within the public. And then finally, for investors, that third bullet point down there is the big key. It's access. It's providing investors that would have never otherwise been able to participate in these deals or even know that these deals were available through platforms like ours and CircleUp and some of the others out there. It provides access at a scale to people that just haven't been able to participate before. And this is just a quick few screenshots of what the platform looks like. Again, these are all Regulation D 506C offerings. So these are available to the public. Anybody can go on the website right now, RealCrowd.com, and you can take a look at all the live offerings. Typically, we like to have anywhere from kind of 4 to 8 offerings at a given time. It's enough to have some variety of opportunities out there, but not enough that overwhelms potential investors and kind of keeps focus on the few at a time. So the main platform is this menu of offerings. And the next slide will show a deal that we closed end of last year, earlier this year. This was a hotel redevelopment right on Market Street in San Francisco. Really cool project, great sponsor out of New York City. Really cool. That's a Yotel, was a hotel ranch. They're going to renovate that building, that brick building just above the streetcar there. So as an investor, you can come in, you can see the highlights of the investment. If you click the next slide, you can see more information about the project specifically, who is the sponsor, who's the group that's running the deal, what are the financials, the offering documents, ask questions directly to the sponsor, whether it's through webinar format or just pick up a phone and call them. Some of the sponsors are still, as Gene mentioned, on the phone world. So ultimately, we want to give an investor enough information in this web experience to be able to make a decision as to whether or not they want to invest. And then the next slide, we'll see it's a fairly straightforward process. Again, we try to make it as low friction as possible to make that initial commitment. So just a few steps there. Once you make that commitment, on the next slide, it'll go into your portfolio, and that'll then walk you through the next steps, which are going to be providing the accreditation. And that's a big thing, and maybe we'll just take a second to talk about the accreditation side. As an issuer, when you make a general solicitation, everybody has to be accredited in the offering under Regulation D 506C. And historically, you could rely on a check-the-box self-certification from an investor that says, I certify I'm worth $1 million, or I make more than $200,000 or $300,000 of income. When you do a general solicitation, that doesn't cut it anymore. So the SEC has said that you have to take quote-unquote reasonable steps to verify accreditation of these investors. And the safe harbor for the SEC is a letter from an attorney, an accountant, a broker-dealer, or a registered investment advisor, stating that third party has taken the steps to verify accreditation. So we tie in with a third-party service to provide that. But as anybody in the audience, if you're a potential issuer, that's one thing that you need to get comfortable around is, how is the platform that you're using verifying that accreditation and making sure that from a security standpoint, as Gene was saying earlier, you're not going to do anything that's going to blow up the offering, as there is a fairly rigid set of regulations around issuing securities this way. And so in the dashboard, again, as an investor, you can see all the process, get accredited, review and send the documents, transfer funds, and that'll go in your portfolio, and you now own your percentage share of that asset. Next slide, just a little bit about what we've done. Just under 80 transactions that we've been a part of. The total value of the real estate of those transactions, a little over $2 billion. Just under 100 million of equity has been invested into those deals through the platform. And the largest capital raise that's been on our platform is about 18.5 million That was for a debt fund that actually just relaunched on the platform again. And I think I believe that's one of the biggest, if not the biggest, offerings that's been raised through a crowdfunding platform here in the U.S. is at $18.5 million. Next slide is a little bit just of the kind of demographic information that we get from our investors. So average age about 45, mid 40s. It definitely skews a little bit younger, more coastal focused because this is a technology platform. We've got millennials that are much more comfortable investing through technology and kind of early adopters. Average investment, the ticket sizes on our platform, I think, are quite a bit higher than what you would anticipate seeing from a quote-unquote crowdfunding platform. Average investment for an individual asset, about $65,000, $70,000 in that range. And then for a fund, it's about twice that. So it's a little over $110,000, $115,000 is the average investment per investor. Average net worth, again, when we do the verification, people are providing that information. So the average net worth of people that go that route is about $9 million. The average income is about $670,000. So it's a fairly, affluent set of investors that are using these platforms. And I think, again, we've done a pretty good job of keeping the quality of real estate company that we work with very high. I think that's attracted a more serious investor set than what you might see for, people that are putting in $2,000 and $5,000. So that's something that we definitely take pride on, is the quality of sponsorships that we work with. And I think that's probably about all I've got. I think that's about it.
Okay, well, thanks very much, Adam. Great to see how successful you've been at this and how well this is going. So you're one of the stories of where crowdfunding can work. So Dara Albright, are you there? Would you?
I am.
Your comments. Okay.
Fantastic. Well, thank you so much, Roger, for having me here today. Excited to be here, and as one of the earliest voices, I guess, advocating for crowd finance, I'm always eager to introduce this whole concept, this whole industry to new people, and to show innovators, investors, and even, in many times conventional financial service providers how they could capitalize on crowd finance. And because there's so much misconception about what crowd finance is, I usually like to start by illustrating by what it is not. So if you could just go to that next slide there. This is a cartoon that I usually start out with. It was published in the New Yorker a few years ago, and it basically depicts these two panhandlers begging for money with a caption that reads, "Remember, we're not begging, we're crowdfunding." And while I usually get a good chuckle when I show this slide, the truth is this really has nothing to do with crowdfunding. If you turn to the next slide, if you realize, crowd finance is really just like regular crowd finance, except for one fundamental exception. Instead of capital coming from big institutions or government entities, it's being raised by pooling small amounts of money from a large crowd of individuals. And really, crowd finance is nothing more than investing in and profiting from the innovation and ingenuity of our fellow citizens. It's what built America in the first place. It's what gave the world some of the most important inventions in the history of mankind. And, of all days like today especially illustrate the advantages and the importance of investing in one another. If you take a look at just what's happening today in our stock market, here the UK declares its independence and US stocks are tanking. Even businesses with zero exposure whatsoever to European markets. And this is really the repercussion of a global financial system that's monopolized by traders who are completely detached from their investments. And what we're seeing today is, instead of being based and valued on fundamentals, U.S. stocks are being priced based on the results of a vote that occurred thousands of miles away on a completely, other continent. And what crowd finance really does is it brings impassioned investors to innovations. It brings impassioned investors to your business, and it really changes the landscape. And by doing so, what it really does is rebalance capital distribution, and ultimately will narrow the wealth divide. I think in its simplest explanation, equity crowd financing is nothing more than the rebalancing of capital from America's corporate conglomerates and financial institutions to its entrepreneurs and to its small retail investors. So that kind of ends the Kool-Aid portion of my presentation, but I'm sure most of you tuned into this webinar to really kind of understand and learn how to use crowdfunding to either start your business or enhance your business. So I prepared just a few remaining slides that will provide some guidance. So on this next slide here, what it really does is compare the various crowd financing structures. And I put this in there to kind of help companies understand which one is right for your business or your startup. Because there's so many different types of crowdfunding that are out there, and each one operates under a different regulatory framework, and each one has its advantages and its disadvantages. So, put this slide together, and the next one too, really to help you determine which one is best for your business. And what I wanted to really do is just contrast some of the various structures. So, you have rewards-based crowdfunding, which many of you know as through Kickstarter or Indiegogo. It's really nothing more than a pre-product sale. It doesn't entail any investing whatsoever and has no impact on a cap table. Anyone could do it. There are no offering thresholds, no filing or reporting requirements, and it's really great for test marketing, brand building, attracting customers, engaging consumer demand. Then what I did was I created some acronyms for all these different structures because people love, and Wall Street loves acronyms. So there's ICOs, which are interstate crowd finance offerings. We touched upon this in the earlier presentation, but this operates under the intrastate exemption. So it operates under Rule 147, which allows a company that's domiciled in a certain state that has its own crowdfunding legislation to raise capital from its residents, from local residents. This is really great for local retailers or restaurants. We now have 33 states that have enacted its own interstate crowdfunding legislation. I've listed them here. Then you have what we started talking about earlier, the 506C exemption, which allows for general solicitation of private offerings. I call them PPOs, which private public offering. And there, some of the advantages are that there's no annual reporting requirements, very limited cost, no offering limits. You get to basically have unfettered general solicitation. The only caveat is that investors must be verified that they are accredited. And it's up to the issuer to ensure that each and every investor is accredited. So this, to me, this is a good structure for a B2B play. But if you really have a consumer-oriented type of business and you want to reach out to your consumer base or grow your consumer base, you really want to focus on one of the other exemptions that allows you to go out to the masses. There's what we call ROCOs, which are the Reg A Plus crowd finance offerings, which allows companies to raise up to $50 million through unaccredited investors. This is ideal, I think, for some more established businesses with a large customer or fan base. Best example of a successful Reg A Plus offering was the recent offering of Elio Motors, which is now trading on the bulletin board. They implemented what's called the testing of the waters component of Reg A Plus to go out and sort of pre-test their offering and see how much demand that they would have before they actually, officially took in money. And it was a very successful offering. They raised about $17 million, and they did it primarily with their customer base. And then lastly is Reg CF, or Title III crowdfunding, which is the latest crowdfunding structure to be implemented. And this is really kind of what when it was first introduced back in 2011 and then signed into law in 2012. This is really the intention, to have unfettered the unfettered ability to raise small amounts of capital from a mass audience of unaccredited investors. And finally, after a couple of years, it's now live. But I would caution, anyone out there that you should keep in mind that Reg CF may change, probably likely to change. There was a bill that was introduced by Congressman Patrick McHenry, who introduced the original crowdfund bill. It's called the Fixed Crowdfunding Act, and it recently passed the House Financial Services Committee just last week by overwhelming majority. And so if that gets signed into law, there are going to be some significant changes with Reg CF, but I think all for the better. And then this next slide just kind of shows what crowd finance is essentially doing. Really, is establishing a entirely new path of capital formation for businesses from startup stage to large cap stage. And I really believe that by following this new path, we're ultimately going to be able to breed more proficient businesses and more productive economies. And just to give you just a real brief example of how it works, say you invent a widget, and you think it's going to be the greatest thing since sliced bread, but before you take a dime of any investor money through rewards-based crowdfunding, you have the opportunity to kind of test it out. And you could use a Kickstarter or an Indigo type of platform, and it gives you an ability to raise some capital to get some prototypes made, for example, through people that might have an interest in actually purchasing that product. It also gives you an ability to determine the viability of the product, gauge market demand, attract customers, build brand awareness, start forming relationships with not only your consumers, but also future investors, because during this new path of capital formation, you're actually going to have the ability to continuously be converting your customers into investors. So it's a really great way to kind of test market the product. Now, let's say the widget that you invented, let's say you try this out with rewards-based crowdfunding and it's a complete flop. Well, the good news is no one lost any money, and you have a chance to go back and perfect the product and try it all over again with no harm, no foul. But let's say it is successful. If it is successful and you want to move on, now you could kind of move on to a more formal round of crowd finance, whether that's through a 506C or whether that's through a Title III Reg CF. And you could go sort of along the path, and as I say, continuously building your brand, continuously building your customer base, and continuously building your investor and shareholder base. And ultimately, let's say you go through all this and then you're ready to be public. It's at some point. Well, no longer do you need a Goldman Sachs to take you public. At this point, you really have an existing investor base to reach out to. And you could really either do, your own direct public offering, or utilize Reg A Plus and go out to your customer base. And and what I think is really interesting is that it doesn't really just stop there, because now let's say your widget becomes, and your company becomes really the next Apple. You still have an ability to go back. Let's say when you want to launch a new product. Launching a new product, you don't have to go to your balance sheet or go out to the markets and raise capital on an unproven product. You can go back to the beginning, go back to the drawing board, utilize rewards-based crowdfunding, and test market the new product. And I think ultimately, if more businesses are bred and are groomed and grow in this manner, the more efficient economies that we're going to have. So finally, just the last slide here, there's so many resources out there to help you, and new companies are emerging every day to help emerging businesses successfully raise capital through the crowd. I'm always posting some helpful resources and new ones on my site. Feel free to visit daraalbright.com to read more, and feel free to also reach out anytime through either email or social media with any questions. I'm always happy to help. Especially because you never know. One of you out there listening today could be building the next technology that will change the world. So feel free to reach out anytime, and good luck.
Well, thanks very much, Dara. Always interesting, and you certainly have amassed a wealth of information on all the alternatives. So Patrick Robinson, would you like to tell us a little bit about CircleUp and what you folks are doing in the market?
Yes, thank you, Roger. Really excited to follow up some of these tremendous presentations, which actually covered a lot of the crowdfunding industry, but excited to share, a little bit about CircleUp, what we do, and our point of view on crowdfunding. So, as I think as Dara's slide just showed, there are so many different types of regulations and exemptions related to crowdfunding. And it sometimes is confusing as an entrepreneur or company to really assess your options out there. So actually CircleUp takes a somewhat unique approach where we view ourselves as a private online investment marketplace. And we really connect the consumer brand, consumer company looking for a private placement with our community of accredited investors. So I think what differentiates our approach a little bit from a lot of the newer regulations around Reg A or Title III is that much of our business is kind of built upon the traditional 506C offering, which is a traditional Reg D exemption. So CircleUp, we are a registered broker-dealer, and we really provide an alternative for companies and also a complement for companies to a traditional offline process for a private placement. And so some of the value we bring is leveraging an online marketplace model and in a community-based model where we can aggregate a lot of demand from accredited investors to specific investment opportunities in privately held companies. So again, the key things there that we focus on are, for the most part, doing 506B Reg D offerings, and then doing a little bit of the 506C Reg offerings as well. And then because of that, we are solely focused on attracting accredited investors to our marketplace. So we've been around for about 4 years. We started back in 2012, with this traditional marketplace model. Since then we've grown slow and steady. So we've helped a little bit over 180 private companies raise a total of about $240 million. And similar to the dynamics that Adam discussed on RealCrowd, we tend to work with a little bit more mature companies where our average fundraise is a little bit over $1 million in equity, and the average investment is actually a little bit over $100,000. So, again, crowdfunding can mean a lot of different things across a company's life cycle, and where we really focus is on early stage growth opportunities. And one unique thing about us is I think we've seen a lot of online platforms focus on specific industries to, one, try to differentiate, and also try to bring value to that specific vertical. So for us, it's really attacking the consumer segment. So we really focus on consumer product goods, anything that's a physical product sold with a brand, and then also high growth retail and restaurant chains as well. So if we move on to the next slide, we can touch a little bit on why we think consumer is such an interesting vertical and actually very interesting for this online, private marketplace model. So, in our mind, the company size and stage, really matters. So typically a company starting off, they could access donation-based crowdfunding platforms like a Kickstarter. They often leverage credit cards to get off the ground, and then their friends and family investors, basically for those initial, that initial capital to come into the business to do initial production runs, get on the shelves of retailers, or set up an online e-commerce. But if we looked at consumer, what we found was there was a large gap between, let's say, a company just getting off the ground and then where a lot of the institutional capital was focused. So there's lots of later stage growth equity funds and private equity funds focused on consumer product companies, let's say 15 and 20 million and above. But there's this really large untapped market of consumer businesses that are kind of $500,000 to 10 or 15 million in revenue in the United States, very high growth. But when they approached the offline fundraising process, they found it very difficult. They would have to travel around the country to try to tap into consumer angel networks. A lot of early stage investors are quite frankly focused on technology. So a lot of our opinion is we wanted to unlock this, this vast asset class and these vast companies out there trying to search for capital to grow their business, and introduce them to investors that make a lot of sense. And I also think the unique thing about consumer, which we found very powerful, given some of the recent regulatory changes, specifically around Title II. So we've touched on this a little bit, where a 506c offering allows a company to generally solicit, in layman's terms, advertise that they are raising capital. So in the consumer space, we've been really excited about seeing companies leverage their early fan bases. They've been able to reach out to their Facebook fans, their social media followers, even their customer list via email, and kind of leverage their very core customers and get them on as investors. So that is actually a framework where some of the newer regulations have really helped us, and said, in this existing framework of a Reg D or a 506 offering, an online platform can really help a company achieve their goals to fundraise by leveraging some of their existing fans. So I think we'll also see this trend emerge throughout other categories as well, whether it's technology, or other consumer verticals. Also the interest of institutional investors coming down to this asset class. So the last thing I wanted to touch on, just as a final slide, is, if you're an entrepreneur, there are all these options, and, quite honestly, the historical way of raising capital offline has been around for a while. So there are all alternatives out there. But if you looked around and you said, why should I use crowdfunding or an online investment marketplace? What are the benefits to me as an entrepreneur? I think the first thing we help entrepreneurs understand is starting a process and leveraging an existing network of a community online really helps act as a forcing function, and it eliminates a lot of the time you spend having those initial conversations where investors might, just take a wait and see approach. So kicking off a process with, someone like a CircleUp or another platform really helps complement your existing investor community and network with another pre-built network of folks specifically invested in the type of offering that you have. And then that helps create a little bit of a competitive dynamic, and also helps streamline the process, where I'm sure if an entrepreneur is out there that has gone through the funding process or the investment diligence process, so many of the investors have similar questions. So kicking off a process, streamlining that, having all of your investors kind of going through a process at the same time really helps you eliminate the waste and help address address some of those diligence questions at the same time. And then the two final things are, platforms like a CircleUp, a RealCrowd in real estate. There's a lot of domain expertise there. So what we like to tell entrepreneurs is, the best companies out there fundraise, maybe 2, 3, maximum 5 times in their lifetime. But these platforms are out there doing these deals every day. So you can leverage a team, with insights to help you set up your raise and help you as an entrepreneur put your best foot forward. And then finally, leveraging software and tools allows you to get more real-time information. So you can have conversations with investors, leverage some of the tools and technology that an online platform allows you to, rather than just kind of depending on the offline process. So that kind of wraps up my kind of key benefits that we talk to entrepreneurs about. Again, we focus on consumer companies, but I think these benefits hold if you're an entrepreneur in any type of vertical. So that's it from my side.
Okay, thanks very much. There seems to be a lot of interest or questions about the Title III crowdfunding, and just for our audience, this is the provision that allows private companies to sell up to $1 million of securities in 12 months to unaccredited investors, subject to limitations. It's relatively small amounts, $2,000 or 5% of annual income or net worth. And we've gotten some new rules recently, so now this is in effect. It's active. These portals can operate. But I wonder if some of our panelists can comment on whether this is workable or not, because I know it's been very controversial. As a lawyer, I've been a little afraid of it just because of the expanded liability potential. But what does our panel think about this sort of crowdfunding? Is that something that you think we're going to?
I can comment on that, Roger. I don't feel that it's workable, and I have a number of people that share my opinion. First of all, you can only raise $1 million. You're probably going to spend $50,000 to $75,000 to raise $1 million. You're restricted in your advertising in that you can only have some very limited information that points you to a portal where your offering is displayed. And so it's very, you can't go out and advertise in other places. You can only point people to that portal. And I feel that's very restrictive. That's my opinion on it, and that it's just not a great way to raise money. That said, it may be workable in some areas for a beauty parlor or a restaurant that's got a local clientele, and they're going to raise a few $100,000 to build out a restaurant or to build a beauty parlor or something for a little local business that has easy access to some sort of user or community base where they can easily reach out to those people and collect money from people that maybe that know them. That's just my opinion. That's what I have to say about it.
Okay, thanks. And that was Gene Massey speaking. Thanks, Gene. Any of our other panelists have a view on this?
Hi, this is Dara. I tend to agree with Gene as well, and I think, I think that the way that the bill was originally intended to the way that it was actually passed. I think it just went through so many iterations and adaptions that I think it really lost track of what the original intention was. I think what will be interesting to see is if McHenry's, the fixed crowdfunding bill ultimately is signed into law, because if it is, I think it significantly enhances it and it will enable much, I think it will enable a lot more companies to use it. I think one of the biggest pieces and components of the of HR 4855, which is the fixed crowdfunding bill, is that it allows funds and SPVs So I think with SPV is a special purpose vehicle. I think it's a game changer because I think that it will really help enhance diversification, both from the issuer perspective as well as the from an investment perspective. And I think that's ultimately going to help. I think it's going to enhance the whole process, and I think it's going to ultimately mitigate risk and allow more people to participate.
Yeah, that'll be really interesting to see how that bill comes out of committee and how it gets passed. Especially, again, it also lessens the liability potential for people who participate in it, like me. So we're looking forward to that. You know, another question here, we've seen so many different alternatives now under crowdfunding and crowdfinancing that one question we have is from a company that has IP, and they're a little concerned about doing a Kickstarter sort of thing, and they don't want to open up the kimono too much. They're wondering which one of these platforms would be best for them if they wanted to go out and raise money through a crowdfunding platform. Would it be a 506B, a 506C, solicited? What would you advise somebody like that? They have IP, they don't want people to know too much about their IP, they can't go to a rewards-based platform. What would you recommend for them?
In the real estate world, we don't deal too much with IP specifically, but there's always a balance of trying to provide enough information that someone's going to get comfortable with the business model, the business plan, or the underlying investment. But obviously, you need to guard your IP. There's, again, some certain mix therein that's the right amount of information, but not enough that you're going to open yourselves up. And so most of the crowdfunding platforms out there, I don't know that you would need to be disclosing, deep entrenched, IP to potential investors, right? As long as you can communicate and tell the story of what it does, why it's important, how they can believe in your ability to execute. The specific details of whatever that IP that you're trying to protect, I don't think needs to be fully on display. And in regards of what the right path to do that is, whether it's 506B or C or regulation CF or even a Kickstarter campaign, it's all going to be fairly similar in the story that you have to tell and the amount of information that you're going to present. So I don't know that there's too much of a distinction between which path you're going to take to get to that capital, because again, you have to tell a similar story regardless of which path you're going down.
Sure, I can chime in. This is Pat from CircleUp as well. So we do deal a lot with this, specifically in consumer packaged goods, something like a food company being very protective of their ingredient mix. So I would just kind of advise companies to think through what is the ultimate audience here. So in CircleUp's point of view, we like to have the privacy and control of just having accredited investors, and then additionally having kind of software tools that allow the entrepreneur and company to decide exactly which investor can see what information in a diligence room. So that's definitely something to keep in the back of your minds and evaluate for all of the platforms out there as an entrepreneur when you're thinking about kicking off a fundraise process.
Okay, thanks very much. One question I'd like to throw out, I guess I'm the moderator, so I get the last question, but I've had several clients now that are using crowdfunding strategically as a marketing tool. They feel like it gives them a real good bump to be able to go out in the market and say, look at this, we did an advertised or solicited offering, and all of these investors are really interested in our company and they want to invest in it. It's given them an opportunity to actually show value of the company and maybe even increase the valuation. Have you guys seen that? Is that a legitimate use of this platform, and is that a benefit of it?
This is Dara. We've definitely seen that in so many areas, and I think that is probably the biggest benefit of really utilizing crowd finance. You know, I mean, you just even see it with a lot of companies that started off as reward-based and then were able to then parlay that successful reward-based campaign into a venture financing. So I think that not enough could be said for the brand building and marketing aspect and benefits of crowd finance.
Any other comments from any other panelists?
Yeah, I mean, in the real estate space, the deal that I showed on the slides, that was a hotel in San Francisco, and part of their big push was for investors. They have a perk set, included with it, so you get VIP access to the rooftop lounge, you get a discount on room rates, you get to go to an annual owners party at the hotel. And so, yeah, to build in kind of that marketing component where you're building awareness for just the overall property, but you're also building at the same time kind of an evangelist user base is something that is certainly another added layer to it. And Pat, I'm not sure most of the companies that you're working with, I mean, again, the consumer product companies, a lot of it is on that marketing front and kind of, again, telling the story and building that user base from these investors as well.
Yeah, exactly. We've seen it. We would be very important for brands to be able to tell their story again with the consumer angle. Interestingly enough, we've also seen big distributors reach out to us. So actually, Amazon reached out to us because we are in the CPG world and says, not only are you guys selecting interesting companies, but they have the funding to grow with us. So oftentimes, third-party resources out there really look to these platforms and say, these are fantastic companies, but also have the financial backing that, we can bet on this company and they're going to deliver. So, I think this is a trend that's definitely not going away, and we look to see more and more, partnerships or resources being attracted to, the crowdfunding space.
Roger, this is Gene. I'd love to just comment slightly on that. Especially the things that are fan-focused, like the virtual reality and video games and movies now, where you have massive online communities that cannot but help the marketing of whatever your device or IP is. For example, we have a model for selling 1 million shares in a movie. And I know that some of the video games have massive interest from even non-accredited investors in their Regulation A offerings, and that cannot but help market, I would think.
Yeah, you would think so. Interesting. Okay, well, thanks very much, panel. I really want to thank you for being here. It's there are lots and lots of crowd financing panels and presentations, and they just seem to get better all the time as the area evolves and the knowledge keeps moving along. I'd like to remind our audience that this webinar has been recorded. You'll be able to find all of the content, including the materials, on Royse University, RoyseUniversity.com, the webinar section. It'll also be available on our Royse Law YouTube site and available for download as a podcast in the iTunes store. Our series is coming to an end next week, but we have a great program that we're putting together starting late summer next fall. We're going to cover things like the gig economy, disaster planning, lots of very relevant and new topics in technology and law. So with that, I want to thank our panelists again for being here. Thank you attendees for attending, and we are going to conclude the webinar.